Joining us now is HSBC Chief Multi-Asset Strategist Max Kettner. Why are you so sure that this is the end of the hiking cycle? I mean, it does feel like that, but also feels like maybe they could go again before the end of the year if inflation stays at these kind of stickier levels above target.
Yeah, but look, I guess it won't do an awful lot of good, right, to go another 25 or another 50. In reality, what we've seen so far is actually there's pretty counterintuitive effect where, particularly the large caps in the US have actually still holding close to record high cash holdings. So they are continuing to really hold these pretty high cash holdings and earning the higher interest on that, whilst on the same time, they've extended maturities, right? They've pushed out maturities, and that means they're actually still perversely benefiting from these higher rates. So, ever higher rates won't actually do anything to solve the problem. It's more about what happens in 2024. It's more about what happens in 2025 as well. So really the next 2 years, if we're going to see those kind of rate cuts that are priced in, or whether the market has to take out a few of those rate cuts that are priced in for the next 24 months. That, in terms of, the crucial questions for equities, for credit, for rates, that's much more important now.
So it does the returns for equities or the continued rise in equities depend on cuts next year, and how soon and how much?
Partially it does. It does in some parts of the equity market, right? So a part of the growthy kind of parts of the equity market, right? NASDAQ, the tech stuff. I'd be probably starting to be a bit more cautious on those part of the market towards the end of the year, right? To me, it's more an environment now where I want to be, starting to bottom fish in the banks, still pretty constructive on energy, right? So still a bit more constructive now on the value side of things. Overall on the direction, I don't think it does that much because let's face it, what happened last year is very different from this year, right? Last year, rates were selling off and yields were massively going higher in anticipation of that massive rate hiking cycle to actually crush the economy, right? It was in anticipation of things to become materially weaker. It was anticipation of a squeeze in margins, a massive earnings recession. This time around, if yields do move a bit higher, right? If we're wrong and the Fed has to go another 25, well, it's the entire opposite, right? It's the exact opposite. It will be as a reaction of things actually being much stronger than expected. So then if you have a couple of dips in equities or in high yield credit, to us, those are the dips that you've got to be pretty quick in actually picking up and buying those dips, which is very much the opposite from last year, where it was in anticipation of weakness. This time around, it's as a reaction of things becoming too good.
You do like EM, but ex-China, and I'm curious, Yellen said this week you can't rule out spillover effects from China. It doesn't sound like you think any of this data is really showing that they're stabilizing.
Yeah, look, on China, I mean, what we are seeing is really pretty broad-based bearishness. You see that in the flows data, right? You see that in the foreign investor flows data. But let's be honest. So for us, EMX China is mostly Latin America, right? It's the nearshoring story in Mexico. It's also, Brazil. That should be also both of those benefiting from a pickup in manufacturing activity, specifically in the US, right? We are seeing definitive signs really of manufacturing activity, and some of those manufacturing PMIs perhaps picking up, and that's really where Latin America can benefit, but also other parts of Asia, right? They're not necessarily really only dependent on China. Think about India, right? India's had a pretty good run. Even markets like Korea, like Taiwan, they've had decent years so far, right? They've had a decent couple of months. So that's not just been a China story. And on China, I would say, look, the sentiment has become very bearish, right? It perhaps doesn't need a lot to actually manufacture a couple of upside surprises. And then, perhaps even China can be a buy going into 2024.